Quickly address specifically the banking space. Samir Bhise, he's the banking research analyst at JM Financial, joins in on the sidelines from their conference. Samir, hi, afternoon. One observes that the market has been pretty prudent in separating the men from the boys when it comes to the banking pack. What are your own observations on how the market is perceiving banks now?
Yeah, hi. Obviously, versus what was the expectation in the earlier part of the year, that probably we are past the peak of asset quality worries. I think last 2 quarters and the substantial slowdown in the overall economic environment has caused some of these worries to come back, primarily driven by the stress in NBFC sector. As we stand today, our view is that we will probably see a higher GNPL print for the sector as a whole over the next 2 quarters. At the same time, what is slightly positive is the fact that banks have largely made provisions on the past stock of bad assets, and incrementally to that extent credit costs may not be as bad as we have seen in 2016-17. However, they may still not come down as what market was expecting 2 to 3 quarters back. So to that extent, we see the sector will slightly remain sideways, within which we continue to prefer larger banks as a pack, given their better capital adequacy, better ability to maneuver through stress cycles, and obviously greater leadership quality in some of the names.
It's interesting that in your views on the banking pack, you've mentioned as to how when it comes to private banking purely, it's actually the Western Maharashtra region which actually comprises and dominates the deposit growth over there. Which banks would you say that in this category then would cherish and enjoy the larger market share? Because I guess increasingly when it comes to private banks, it's going to be really a fight about who gets how much share when it comes to both retail as well as the corporate book.
So specifically on that point, obviously Western region remains a relatively deposit-rich region in the overall geographical spread in our country. To that extent, I think some of the larger names, given their deeper and denser distribution network, would continue to benefit. They continue to gain market share on deposits, both SA as well as CA and term deposits from PSU banks. So that process, I think, is more of a structural play which has been happening for over a long period of time, and I think there is still some more way to go, that private banks will continue to gain market share as distribution grows, and as given their better investments in technology and better reach to the consumer, they will continue to gain market share. As I said earlier, larger banks are relatively better placed, and that is where our preference lies. With respect to asset market share, I think we need to see corporate and retail market shares separately. Over the last decade or so, retail assets have done phenomenally well, and obviously some of the larger private sector peers, private sector banks have benefited. As we stand today, there is a slight bit of slowdown on retail demand. Is it structural? We don't think so. It is more of a cyclical at this point in time, is what data suggests. So we still will stick out our guns and continue to back these large private banks.
Okay. Thanks for joining us, Samir.